Welcome back to the deep dive. Today, we're doing a really focused analysis, looking at Noama Wealth Management Limited. We're going beyond just the basic Q2 FY26 earnings release. We're really digging into the earnings call commentary and those investor decks you shared.
That's right. And our mission, I think, is pretty clear. We need to get past the headline figures. What we're really trying to do is pull out the strategic shifts, right? The long-term growth drivers across their whole platform. So that's wealth management, asset management, and capital management, too. We're trying to get a handle on how they're positioning themselves in India's, well, evolving financial scene.
Okay, let's kick off with that overall financial picture. It was a, shall we say, complex quarter, but the numbers do show some resilience. Total revenues, they grew about 4% year on year in Q2. And for the first half, that's holding at a solid 10% growth. Operating PAT. Well, it was pretty much flat in Q2, technically down 1% year on year, but still up a healthy 8% for H1.
hmm And if you look at capital efficiency, the return on equity, the ROE, that's standing really strong, nearly 29% for H1 FY26. And that 29%, well, it's a crucial number. It sets a really high benchmark for the industry. It signals their capital is being put to work exceptionally well, which, is vital when a company's chasing growth on multiple fronts like this.
Okay, yeah, let's unpack that a bit because when you look under the hood, it's the core wealth and private segments. They're clearly the engine here, aren't they? Their profit before tax, the PBT, that really shows the momentum. It jumped substantially 27% year on year in Q2 and 23% for the half year.
Exactly. And what's really interesting here is how their deliberate strategy shift shows up in the revenue mix. The contribution from those higher margin, stickier wealth and private businesses, it actually hit 57% of total revenue in Q2.
Yeah.
Now, that's a huge leap from 47% just the year before. That 10-point shift, it really points to a successful de-risking strategy. They're becoming less dependent on those volatile market activities.
Right, and that focus really comes through in the Managed Products and Investment Solutions area, MPIS as they call it. The sources show MPIS revenues exploding, up a massive 67% year on year. And crucially, they've managed to push that volatile broking revenue way down. It's less than 10 or 11% of overall revenue now. I mean, that's pretty much the definition of successfully shifting towards recurring revenue, isn't it?
It really is. And the private business, the part serving ultra-high net worth individuals and family offices, just adds more proof. Their annual recurring revenue, or ARR, earning assets, they crossed that huge 50,000 crore mark. But the key thing there is the speed. They actually doubled those assets in just 2.5 years. That confirms a really strong 24% year-on-year growth, driven by those HNW clients needing specialized services.
Okay, and that leads us straight into technology, doesn't it? Because those high net worth clients, they expect, well, personalization at scale.
Hmm.
The sources talk about big steps forward in their tech stack to meet that exact demand. And this is where it gets, I think, really interesting.
Yeah, they're definitely building a serious competitive advantage here.
The specifics of their tech. It's all about making complex family wealth actually manageable. They now offer truly consolidated family-level reporting. That's incredibly hard to pull off in India. And this reporting, it's not just basic stocks and bonds. It covers the complex stuff. AIFs, general insurance, OTC fixed income, unlisted assets, even complex income tax calculations, all integrated seamlessly on mobile and web platforms.
That consolidation alone must be a massive selling point because those UHNIs, their money's usually scattered all over the place, right? Different platforms, different distributors.
Yeah.
And building on that, they've jumped into generative AI, piloted a portfolio advisory solution using GenAI with their top 30,000 to 35,000 clients.
Yeah.
So what exactly is this GenAI doing that, say, a traditional advisor can't do as quickly? It just speeds up the advisory process dramatically. The solution lets clients see their whole portfolio, even stuff spread across different distributors. And then this is the critical part. They can model allocation changes in real time. So it's moving beyond just reporting what happened to proactively planning what-if scenarios. And the internal feedback, they're saying it's very, very encouraging. It suggests tech isn't just about saving costs, it's directly boosting the quality and speed of advice.
Right, so that high margin, high tech advisory piece is clearly delivering. But let's shift gears a bit. Let's talk about where rapid growth can sometimes cause temporary bumps to the lending business.
An important pivot, yeah. Their loan book grew massively, something like 40% in just one quarter. So that confirms a very aggressive expansion plan. However, the net interest income, the NII growth, it lagged behind that big expansion. And this is where RBI rules created a sort of technical timing issue that's really important to grasp.
Okay, explain that timing issue for us. What happened there?
Well, because that huge 40% loan growth happened late in Q2, The company was immediately required by RBI guidelines to book the expected credit losses, the ECL, upfront in that same quarter. So essentially, the cost of scaling that provision for potential future losses, it hit the P&L in Q2. But the interest revenue from those new loans, that won't fully show up until Q3. The temporary accounting drag, basically. The costs came before the full revenue benefits.
Got it. So purely a timing thing on the P&L that hides the underlying growth in assets. Okay. And speaking of regulations, the sources had a pretty specific take on the regulatory environment.
They did. The general feeling inside the company seems to be that both SEBI and RBI are practicing what they call disciplined pragmatism. Now, that can cause some short-term strain, with new rules popping up. But the company's view is that this discipline will ultimately have a big multiplier effect on the industry long-term by sort of stabilizing how markets behave.
Yeah.
They even pointed a positive surprise, the loosening of capital market exposure limits for banks.
Interesting. Okay, let's move on to the people side, the talent strategy, which really underpins that whole wealth segment. They've got a large base of relationship managers, RMs, and apparently about 30% of them have less than a year's experience. They're clearly trying to upgrade the sales force.
Absolutely. They're executing a very clear quality over quantity strategy here. They're actively changing the mix, replacing some of the lower cost, maybe less experienced RMs with higher vintage, more seasoned bank RMs. And they actually quantified it, they said. In terms of productivity and skill set, 1 incoming is equal to almost 2 outgoing. That's a pretty bold claim.
It sounds incredibly aggressive, very targeted, but doesn't that kind of rapid change, swapping out less experienced people for more expensive, higher vintage talent, doesn't that carry a big short-term execution risk, potential client churn or higher acquisition costs? Did the sources say anything about managing that risk?
Well, the focus seems clearly on long-term profitability and reducing the risk associated with maybe less experienced talent down the line. By bringing in RMs who already have proven track records, bigger books of business, deeper skills, they're accepting that higher immediate cost. But the payoff is meant to be greater long-term stability and, importantly, higher ARR asset capture from day one. The sources really emphasize the goal isn't just swapping bodies. It's about capturing a much larger share of the client's wallet straight away, which should offset that higher cost pretty quickly.
Okay, that makes the cost side clearer. Right, let's shift focus again, this time to the future of asset management. Big news here, they got in-principle approval to set up a mutual fund. Now, they already run AIF, so why is this specific MF approval such a big deal for them?
Oh, this is potentially a major structural game changer, and it really boils down to 2 things, tax and market size. See, this approval lets them launch special investment funds, or SAFs. And for the kinds of strategies they already run, long, short, absolute return, SAFs offer a really significant tax advantage compared to the alternative investment fund structure, the AIFs. Basically, let them sidestep some specific tax complexities that come with AIFs for those particular strategies.
Okay, tax advantage, got it. And what about market reach? How does that change things?
It's completely transformative. The minimum investment ticket size plummets. It goes from the typical AIF level of, say, euro crore, all the way down to just 10 lakhs. Suddenly, that opens up huge mainstream distribution channels that were basically off limits before, think, major bank networks, other wealth managers. This isn't accidental. It's a calculated move to take what was a niche, high-margin product and potentially turn it into something for the mass affluent market. And they're moving fast. They aim to go live by April. That's a really tight 6-month deadline they've set themselves.
Wow, okay, so a clear plan to massively scale that whole product segment. Separately, they also talked about continued success in their commercial real estate, the CRE fund area.
Yes, and they're really using their wealth platform smartly here to get capital deployed. They've leased about 2,400 crore of their 4,000 crore target for that CRE fund. And they highlighted their second big investment, a fully leased 2.4 million square foot office space down in Chennai. Total value around 2,600 crore. But here's the synergy part that's important. Half of that investment was immediately syndicated out onto the public markets. It just shows how neatly their asset management and capital management arms work together to structure and place these complex deals.
So while all these strategic moves look strong, we do need to touch on the one sort of significant challenge they mentioned facing in asset services.
Absolutely, yes. They lost one very large institutional client early in the quarter, and that caused a noticeable dip year on year in their assets under custody and clearing.
Right. So what does that episode tell us about the platform's resilience? How do they handle it?
Well, the recovery story seems quite strong. The sources were very specific about this. They said they recovered 50% of that lost revenue by the end of Q2 itself. And they expect to get the remaining 50% back relatively quickly, maybe by January or February. So it shows they could adapt immediately. They recalibrated their strategy, focus on existing clients, and push hard on building a new pipeline, both here in India and internationally. It suggests, that the loss was probably client-specific, not some systemic weakness in the service.
Okay, good context. Finally, let's quickly cover the direct actions the board took aimed at shareholders and maybe future market perception.
Right. Two key things. First, the board declared a pretty substantial interim dividend, 70 euros per share. That works out to about 49–50% of their first half profit. So it's a strong signal of confidence in their cash flow.
And the other big one, the stock split. The board approved a 5-for-1 split. Face value goes from 10 down to euro. Now, a stock split isn't just, accounting smoke and mirrors. It sends a very clear message, doesn't it?
It does. And it's entirely focused on boosting liquidity.
Right.
They explicitly said it's to encourage more participation from retail investors. They even mentioned that apparently many existing retail holders have fewer than 10 shares right now. So it indicates they're actively trying to broaden the shareholder base, increase the trading flow, which kind of aligns with their whole growth strategy, right?
Yeah.
Opening up new markets via lower ticket sizes, just like they're doing with the SEFs.
So wrapping this up, this deep dive really confirms we're seeing a company that's successfully doubling down on those high-yield recurring revenue streams, wealth, and private banking. But at the same time, they're strategically opening up several new, potentially very high-growth avenues, like through these sophisticated SEFs and that aggressive talent upgrade program.
Yeah, exactly. We've seen that strategic tech adoption with Gen AI right at the heart of their advisory model now. We've seen decisive capital management moves like that 5-for-1 stock split.
Yeah.
And the aggressive talent shift. It's all geared towards capturing future growth and cementing that high-margin market position.
Okay, so here's a final thought for you, our listener, to take away. Considering those immediate pressure points we talked about, that specific asset service client loss, the technical timing hit on lending NII, the always volatile capital market segment, how effectively can these big strategic long-term pivots, things like the SEF launch, the Gen AI rollout, the RM upgrades, how effectively can those actually shield the company from the inevitable short-term market noise over, say, the next 4 quarters? That's the critical question to ponder.